Welcome to the deep dive. The market's been giving some folks a bit of a roller coaster ride lately.
Yeah, definitely.
The S&P 500, it's seen a pretty significant drop, actually, more than 15% from its recent peak.
Mm-hmm.
And, well, a lot of that seems tied to these concerns about tariffs, how they might ripple through the economy, maybe cause a recession.
Absolutely. And what's interesting is that these kind of broader market jitters, well, they can sometimes create opportunities.
Opportunities? How so?
Well, even companies with really solid foundations,
Mm.
they can see their stock prices get pulled down in that kind of environment. It's not always company specific.
Which is exactly where our focus is today, yeah. We've been looking at 3 companies, all in the S&P 500, ExxonMobil, Federal Realty Investment Trust, and PepsiCo.
Oh?
And all 3 have seen their stocks drop by 15% or more recently. But the fascinating thing about these 3, it's their dividends, their long-standing commitment to rewarding shareholders.
That's the key point. Despite this recent market turbulence affecting their stock prices, these companies have consistently delivered dividends and often increased them for years and years.
Right.
So for you, if you're a long-term investor, maybe focused on getting a steady income stream, that kind of track record can be really compelling, especially when the price dips.
So our goal in this deep dive really is to understand why these 3 are being talked about as potentially strong buy and hold forever kind of dividend stocks, even with all the current market uncertainty.
Makes sense. Where should we start?
Okay, let's dig into ExxonMobil first. Their stock, like we said, down over 15% from its high point.
Yeah. And, well, as a direct result of that price decline, their dividend yield has become considerably more attractive. It's jumped up to 3.8%.
3.8%. How does that compare?
Well, to put that into context for you, that's more than double the average dividend yield you'd find across the S&P 500 right now. The average is hovering around 1.4%.
Wow, okay. So more than double the average. That's a pretty significant jump in income potential.
It really is.
And it's not just a high current yield, right?
Yeah.
ExxonMobil also has this deep history of actually increasing those payouts over time.
Precisely.
Yeah.
Yeah, they recently announced another increase, actually. 4% this time.
Okay.
And what makes this particularly noteworthy is that it marks their, get this, 42nd consecutive year of dividend growth.
42 years straight.
42 straight years. Think about that, over 4 decades of consistently returning more capital to shareholders each year.
That's incredible stability.
It really is. Only a tiny fraction of S&P 500 companies, something like 4%, have actually achieved that kind of consistency. It really speaks to the long-term resilience of their business model.
42 years. I mean, that's seen a few economic cycles come and go, hasn't it? Definitely suggests a certain level of stability.
Yeah.
Beyond their past performance, though, what does their current financial picture look like? Can they keep it up?
Well, their recent financials, they paint a pretty clear picture of their ability to sustain and probably grow those dividends.
Yeah.
Last year, for example, ExxonMobil generated a substantial $34.4 billion in free cash flow.
$34.4 billion. Okay.
Now, when you compare that to the $16.7 billion they actually paid out in dividends.
Ah, okay. Big difference.
Right. It gives you a good sense of the buffer they have, their capacity to continue those payments. A healthy free cash flow level relative to the dividend payout is really a key indicator for dividend sustainability.
So they're generating significantly more cash than they're actually distributing to shareholders. That sounds like a pretty solid foundation for future payouts.
It does.
What about their plans looking ahead? Are they, positioned to keep that cash flow strong or even grow it?
Their long-term strategy seems geared towards exactly that.
Yeah.
ExxonMobil has laid out plans to increase their annual cash flow by a really significant amount, $30 billion by 2030.
Another $30 billion.
Well, they're aiming to achieve this through a combination of things. Cost-saving measures, for one, and also by strategically investing in what they consider to be low-cost, high-return assets.
Makes sense. Efficiency and smart investments.
Exactly. This focus on efficiency and profitable growth, it really suggests that continued dividend growth is likely to remain a key priority for them.
Okay, interesting. Let's shift gears then. Let's look at Federal Realty Investment Trust. Now, their stock has seen an even steeper decline recently, hasn't it?
Yes, that's right. Federal Realty stock, it's dropped by more than 20% from its recent peak.
20%? Wow.
Yeah. And, similar to ExxonMobil, This price decrease has bumped their dividend yield up quite a bit. It's now at a very attractive 4.8%.
4.8%, almost 5%. That's certainly going to grab attention.
Hmm.
And I hear their dividend growth history is kind of legendary in the REIT sector, isn't it?
It truly is. I mean, legendary is a good word for it. Federal Realty has increased its dividend payout for an incredible 57 straight years.
57.
57.
Mm.
Consecutive. That's not just the longest streak among all real estate investment trusts or REITs.
Yeah.
It puts them in that very exclusive club of Dividend Kings. Companies that have hit 50 or more consecutive years of annual dividend increases.
Dividend King. Okay. That designation, I imagine, is seen by investors as a strong signal. Stability, commitment to shareholders.
Absolutely. It's a huge badge of honor, essentially. Shows incredible long-term performance and reliability.
57 years, though. What is it about their business model? How have they managed to maintain and grow those dividends so consistently through all sorts of economic ups and downs?
Well, their strategy is quite deliberate. It's
Yep.
focused. Federal Realty primarily owns and operates what they consider to be, high-quality shopping centers and also mixed-use properties.
Okay, high quality. Where are they located?
Crucially, they target locations in the inner-ring suburbs of major cities,
Yeah.
the areas just outside the downtown core. And these areas tend to have high population density and, importantly, higher than average household incomes.
Gotcha. So a specific demographic profile.
Exactly. That profile typically translates to strong and consistent demand from businesses wanting to locate there. Retailers, restaurants, services. They want to be where those customers are.
That makes sense. So businesses in those prime locations likely see consistent customer traffic, which means stable rental income for Federal Realty.
Precisely. And because demand is generally high in these specific locations, Federal Realty often has the ability to steadily increase the rental rates they charge over time. That's key for dividend growth.
Okay, so they're not just sitting back then.
Oh, no, not at all. They are not passive owners. They actively reinvest in their portfolio. They redevelop existing properties to keep them modern, attractive, maybe add density.
Constantly upgrading?
Yes. And they also strategically acquire new, high-quality locations when opportunities arise. And often, they'll fund these moves by selling off properties that maybe no longer fit their strategic vision, maybe lower growth assets.
Right, refining the portfolio.
Exactly. It's a continuous cycle of upgrading and refining, focusing on quality.
So it sounds like a really targeted focus on prime, resilient locations, plus that proactive approach to managing the properties.
Right.
That seems to be the bedrock of their long-term dividend growth.
I think that's a very good summary, yes.
Okay. Now, let's turn our attention to our third one, PepsiCo. Their stock has also seen a significant dip, right?
That's right. PepsiCo stock is also down by more than 20% from its recent high.
Another 20%er. And the yield,
As a result, their forward dividend yield has risen to around 4%.
4%. Another solid yield in this group. And they also have an impressive dividend growth streak, placing them among those dividend kings, too.
Indeed. Another king. Earlier this year, PepsiCo announced another dividend increase, 5% this time, which will start being paid out in June.
Okay, 5% boost.
Yep. And this extends their remarkable streak of annual dividend increases to 53 years.
53 years, wow.
So yeah, they are firmly in that elite group. Over half a century of consistent dividend growth. Just incredible consistency.
53 years is amazing. Now,
Yeah.
PepsiCo, I mean, it's such a ubiquitous company, right? A massive portfolio of products. How does that broad diversification help them consistently grow their dividend like that?
Well, that diverse portfolio of leading brands is definitely a significant source of strength. I mean, think about the range you've got there.
Yeah, Pepsi, Gatorade.
Right. Pepsi, Gatorade, Quaker Oats, Lay's chips, Fritos. These are all household names, staples really, with strong market share.
Right. Stuff people buy regularly.
Exactly. And they generate a relatively stable and growing stream of earnings and cash flow for the company because of that. This diversification across both beverages and snacks provides a real level of resilience.
How so?
Well, different product categories might perform differently depending on consumer trends or, economic conditions. If beverage sales slow, maybe snack sales pick up or vice versa. It smooths things out.
Ah, okay. Balances things out.
Yeah. And also, just the non-cyclical nature of consumer staples plays a big role here. I mean, people tend to continue buying food and beverages even during economic slowdowns, right? It's not like buying a new car.
That makes sense. People still need to eat and drink regardless of the broader economy, so that provides a baseline level of demand for their product.
Exactly. A reliable baseline.
What about their plans for future growth, though? Are they just sort of relying on these existing powerhouse brands? Or are they actively pushing for more?
Oh, not at all, just relying on the past. PepsiCo has established some pretty clear long-term financial targets. They include organic revenue growth, that's growth from their existing businesses in the range of 4% to 6% annually.
4 to 6% organic growth. Okay.
Yep. And they also have a focus on expanding their profit margins. They believe that combination will support high single-digit growth in their earnings per share over the long term.
High single digits for EPS growth, and how do they plan to achieve those goals?
Well, they make significant annual investments across various areas. This includes things like product innovation, keeping their offerings fresh, appealing to, evolving consumer tastes, health trends.
Right, keeping things relevant.
Exactly. Also expanding their manufacturing capacity to meet demand and enhancing efficiency through things like digitalization, automation, and improvements in their logistics network, getting products to shelves efficiently.
So they're actively investing in innovation and efficiency to drive future growth, not just coasting.
Definitely not coasting. And I understand they also leverage their strong financial position to make strategic acquisitions sometimes.
Yeah, how does that fit in?
That's correct. PepsiCo maintains a really robust balance sheet, very strong financially, and that gives them the flexibility to pursue strategic acquisitions when they identify opportunities, maybe to accelerate growth or expand into new markets or categories.
Got any recent examples?
We've actually seen some recent examples, yeah. Like their agreement to acquire Poppi for about $1.7 billion. Poppi is in that fast-growing, better-for-you prebiotic soda category.
Oh, yeah, okay. Tapping into health trends.
Exactly. Expanding their footprint there, and also their $1.2 billion acquisition of C8 Family Foods.
Cite, what do they do?
They have popular grain-free tortillas, chips, Mexican-American food products. So that strengthens PepsiCo's position in the food portfolio, particularly with those kinds of offerings.
Interesting. So these moves really demonstrate their proactive approach, seeking out new avenues for growth beyond just their core brands.
Absolutely. They're always looking to adapt and expand.
Okay, so let's try and bring it all together. We've looked at these three companies, ExxonMobil, Federal Realty, and PepsiCo. All have experienced pretty significant stock price declines, right? Over 15% in each case from their recent highs.
Yes, exactly. And this downturn, as we've discussed, has made their dividend yields notably more attractive than they were, say, 6 months or a year ago.
Right, higher yields now.
Yes, but the crucial point for you, the listener, to understand is that these aren't just sort of randomly high-yielding stocks. They are companies with these remarkably long, consistent histories of not only paying dividends, but also increasing those payouts year after year after year.
Decades in these cases.
Decades, yes.
Yeah.
This track record, when you couple it with the fundamental strengths of their underlying businesses that we talked about, and their strategic plans for future growth and financial stability, well, it suggests a strong potential for them to continue raising their dividends in the years ahead.
Which, as we've seen, could position them as potentially compelling buy and hold forever type stocks.
Yeah.
Particularly for investors who are prioritizing a reliable and hopefully growing income stream over the long term.
Exactly. Their demonstrated resilience through all sorts of economic conditions, their consistent commitment to returning value to shareholders via dividends, and their forward-looking strategies. It all points to their potential as durable, long-term income generators.
This whole discussion, it really leads to an interesting question for you, the listener, to maybe ponder.
Mm-hmm.
Considering the factors that have contributed to the S&P 500's recent pullback, the tariff concerns, recession fears, and thinking about the specific strategies that ExxonMobil, Federal Realty, and PepsiCo are using within their own industries. Well, what other seemingly stable sectors or maybe individual companies might currently be presenting similar kinds of opportunities for investors focused on that long-term income?
That's a great question. It's definitely food for thought as you consider your own investment approach.
Right. Are there other babies thrown out with the bathwater?
Potentially. Absolutely. By applying a similar kind of lens, looking for companies with significant recent stock declines, but also that strong history of dividend growth and solid underlying fundamentals, you might just uncover other compelling investment ideas in the current market environment, ideas that align with your specific income goals.
Well, this deep dive has definitely given us some really valuable insights into why these three ExxonMobil, Federal Realty Investment Trust, and PepsiCo are being highlighted as potentially strong long-term dividend investments, especially right now during this market downturn.
Yeah, I think we've seen how their impressive dividend growth streaks, which are really underpinned by their respective business strategies and their overall financial health, could make them particularly attractive, especially for those of you seeking a dependable income stream from your investments over time.
And we really want to encourage you, the listener, to take this as, a starting point for your own research. Definitely dig deeper. Consider how these specific companies or others like them might fit within your individual investment objectives and, importantly, your personal tolerance for risk.
That's key. And it might also be worthwhile, perhaps, to explore the historical performance of companies with long dividend growth records, like these Dividend Kings we discussed. See how they've typically fared during previous periods of market uncertainty or downturns? History doesn't repeat, but it can offer perspective.
Absolutely. Some valuable homework, perhaps. Thanks for joining us for this deep dive.